Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at my stock portfolio. I'm going to do a quick update on how things are going right now with the market dropping. Right, we're in February 29th. The market just dropped over 12% from its all-time highs. We're in correction territory, so I want to talk about my current portfolio. In this episode, like I said, I'm going to talk about my current portfolio and performance compared to the SPY portfolio. Second, unfortunately, I broke a rule that I have when investing, and we're going to see how much that broken rule cost me and what I ended up learning from that rule. Next, I'm going to show my holdings and compare them to what my holdings looked like just a few months ago, just about a month ago, and see how my rule that I broke affected things. And then I'm going to talk about what my update is with the current stock portfolio and things I'm going to work on, things I've learned, and things that I'm going to continue to do as if the market continues to drop. So let's get started. Stock market performance. The stock market from its all-time highs has dropped about 12%. And if you guys haven't, don't forget to subscribe. I mainly post content on companies that I take a look at, but from time to time, every 2-3 weeks, maybe sometimes once a month, I post about my portfolio. So let's take a look at my stock portfolio performance. Let's just go right off the bat. First, I started this account on November 7th, 2019. And this was when the market was at its all-time highs at that moment. And there were 3 reasons I made this portfolio. First is I wanted to show how I would invest when the market was at all-time highs. Second, I wanted to do this portfolio based on my YouTube videos. Like I mentioned before, right? I do YouTube videos on companies that I do research on. And if I like that company, then I'll proceed to purchase it. And that's what I'm doing this video on, this portfolio on. And third, it's to keep track. It's pretty much a diary for myself to help me understand, right? Since I do a video at least once a month on my stock portfolio, it helps me keep track on how my account is doing, and it helps me understand what I did wrong, what I did good, and helps me learn. So yeah, those are the 3 purposes. So this account started 3 months ago. So 3 months ago, it started in November 7th, 2019. And right now we're in February, almost the start of March. So a little bit over 3 months. I started this account at $15,000. On 11/7th, I dropped $2,500, and 11/8th, I dropped $12,587. So $15,087 to be exact was with this position started. And then every 2 weeks, I deposit a set amount of my income into this portfolio. I have another portfolio outside of this that I also deposit money. And eventually, that portfolio I invest differently than this portfolio, and I'll take a look at that portfolio later. I'll probably show that portfolio later on. But at the moment, this is my most important portfolio based on my YouTube videos. So you can see, right, every 2 weeks I deposit money, and right now it's a constant $431.03. My last deposit was on the 24th, and based on cash deposit, if I just had total cash, the amount of cash I deposited has been $18,484. And I think that alone shows how crazy or how good it is to constantly just keep putting money into your account. If you keep putting money into your account, it just keeps growing and growing. Right? In just a few months, it grew just by dropping money. It has grown on itself. And it's something that you do. This is automatic for me. It automatically takes out of my paycheck and it goes there. So it's money that I don't even see in my paycheck. So I don't have to worry about, hey, what if I had this money? So that I just wanted to show that. So then I wanted to look at the returns of the SPY, right? So every day, each of these days, I deposited money, right? I said, what if I bought the SPY based on that amount I purchased, and on those returns on those dates. So if I would have purchased, right, the SPY when I dropped $2,500 on November 7th, I have the returns for each of those dates. If I would have just invested in the SPY portfolio, my portfolio would be down 4.75%. 4.75%. That's a pretty big drop. It would be 5% down. So my amount invested would have been $1,700 17,600. That's about $800 less than how much I started. And that's not a good feeling, right? That's not a good feeling. My invested portfolio, my portfolio based on my holdings, is actually doing much better. And I'm actually pretty happy that it is. My invested portfolio is still in the red, unfortunately, but it's down not even 0.5%. So it's doing almost 9 times better than if I was invested in the SPY portfolio. And right, so like I said, it's still down. My $18,484, it has actually turned to $18,393. So I'm down about $90, opposed to almost $800 that I would have been down if I would have invested in the SPY. And right, investing in the SPY is what I would consider for most passive investors. If you guys just want to grow in passive investing, if I was a passive investor, I would just do SPY. That's okay, 100% sure. But I am an active investor. I really move around what companies I invest. So I put time in. I put tons and tons of time in. So I would hope my returns would be doing better than the SPY. And so it is, and it's working out for me, and I'm happy for that. And I'm also happy because if you guys have seen my previous videos, my stock market account, when it was at all-time highs, my account was matching the SPY. So when it was all-time high, it was matching the SPY, and now when it's at when it's a low, my portfolio is not matching the SPY, and that's great, right? So I'm matching the returns, but I'm not matching the declines. I'm matching the positive, but I'm not matching the decrease. So now here, when the market goes back up, I'll be able to, in theory, I should be able to beat the market, and that's what I'm hoping. And another good thing is, if you guys have seen my video, I am not fully invested. I had about 20 to 25, maybe 30% in cash in my last video. And so I was matching the portfolio with only 70% of cash. So that to me was a great, that was to me was another great thing that I was knowing. Hey, it's like, hey, I'm only using 70% of cash, but I'm matching a SPY portfolio that was 100% invested in cash. So I knew if some downturn happened, I had money at hand. And I'm not saying I'm the smartest investor, right? I just know that the best way to make money and the best way to have your portfolio growth and not make stupid mistakes is if you have a plan and to understand your risk comfortable, right? The market was all-time highs. I wanted to ride that wave, so that's why I put about 75 to 80% of my money to work, but I still had some form of, I wasn't fully, I guess my risk tolerance was not that high, that I felt that, hey, maybe I wanted to keep 20% in cash. And that's my risk tolerance, right? That was my risk tolerance telling me that, hey, you won't feel comfortable in being invested by that much. And that's something I feel like every investor needs to understand. They need to know, hey, when I'm sleeping tonight and if the stock market crashes tomorrow or whatever happens, how much would I be happy if I still had in cash? Or how much would I be willing to have in cash? Or if I was 100% invested and the stock market crashed, there are people that might not care, right? They might be like, hey, the stock market historically has continued to go up. The only time you hit in the SPY portfolio, if you have lost money, is if you sold too early. So some people are like, hey, 100% invested, let's go all in. I feel 100% comfortable with that. Again, I feel like there's no wrong answer to how your investment style is, as long as you follow the plan. Because the moment you unfollow your plan is the moment things start to go bad. And unfortunately, that's what ended up happening to me. And I'm going to talk about that in a bit. So then here, this is pretty much a big bunch of nonsense at the moment. And I'm going to talk about the rule I ended up breaking. So actually, let's just go back to the other slide. The rule that I ended up breaking is I only invested in companies I did full research on. I only invested in companies I did full research on. But I only wanted to keep about 20 to 15% of cash at all times. Unfortunately, which is not a bad thing, unfortunately, money coming into my account and I wasn't able to research that many companies to my acceptance fast enough. So my cash position kept growing faster than I was actually spending and putting it into a company or into something. So what ended up happening is I had too much money at hand, um, and I'm like, hey, I need to put this money to work. So what I ended up doing is earnings seasons just came up, and there are so many companies that I wanted to look at. But honestly, one as I'm a full-time worker, I didn't have the time. So I ended up bending my rule a little bit, and this is where things started to go bad. I ended up bending my rule a little bit, and but to some extent, I started buying companies that were dropping on earnings that I wanted to invest on, but I didn't do a full analysis on them yet. So what I ended up doing to do, I understood I was breaking my rule. So that was my number one thing. I understood that I was breaking my rule by not doing my full research on the company, but because I knew I was breaking that rule, I made a new rule that I would only buy a very small position in these companies. So like that, I can create some form of watch list that, hey, if the company goes up, I can ride it a little bit up. But it also told me, hey, these are the companies I need to invest next on. So what ended up happening is, if you take a look here, all the green ones are companies that I ended up buying. Because I wanted to spend cash, and either they had dropped a bit or I really liked their earnings, but did not do a full research on them. So I started buying small positions. So I bought Facebook, I bought Luckin Coffee, I bought Take Two Interactive, Turtle Beach, I bought Uber, I sold my Macy's account. And the reason I sold my Macy's was because I understood that, hey, Macy's for me, it was no longer fitting my investment style. So it was a winner for me, a small winner for me. So I'm like, hey, I'm taking it out because I feel like my money can be used somewhere else. So I sold my Macy's, I bought Pindu, I bought Pinterest, and I bought Roku. So this brought down, if we're going to take a look in a bit, this brought down my cash position from like 30% down to 7%. So it dropped down to 7%. And I'm like, all right, now I'm good. I'm using a lot of my cash at hands. And unfortunately, I still knew I broke that rule. And that kind of broke my risk tolerance that I was talking about. And then what happened? February 21st happened. So February 21st was when the market really started to react to this coronavirus aspect. It was the first big drop compared to how the overall market was doing. And my risk tolerance started to punch me in the gut. It was punching me, and I was like cringing, and I'm like, oh man, I messed up. And this is why I knew I messed up. I knew I messed up because, one, I did not have the amount of cash ready at hand that I was supposed to have, that my risk tolerance told me. It's like, hey, always have 20% at hand. And look, you messed up, you screwed up, and this is what you get. So then I had to start thinking. I'm like, what is the main thing punching me in the gut? Like, what is my risk tolerance not liking about my portfolio? And I was looking at my big companies, not my big companies, the companies that have done research on, and I'm like, if these companies go down, these are the ones I'm gonna buy. And I started looking at my portfolio, and I'm like, I started thinking, right? This is when you go to your investing thought process, and I'm like, if the stock market drops more, which are the companies I'm not gonna want to buy right now? If I had money right now, which are the companies I'm gonna want to buy, and which are the companies I'm not gonna want to buy? And obviously, the ones that I did not, right? Comment, like, if you guys know where I'm going. The companies that I did not want to buy were the companies that I had yet to do any research on. And that to me was like, bam, I broke my rule. And now I have two decisions. I have number one decision is take the loss, take a bit of a loss that I've taken. If any, most of these weren't at a big loss, so that was a good thing. But it was like, take the loss now. It was either take the loss now, or this was just a moment lapse. And what if the coronavirus, right? I think this was on a Friday. So it was like, weekend might be good. Stock market will continue back. So continue to ride the wave. But like you said, right? I had that risk tolerance telling me, hey, your stomach won't handle it. Which way would your stomach not handle it the worst, right? So you have to understand the type of person you are. It was like, if the stock market continued to drop next week, would you be punching yourself in the gut? And I was like, yes. And then I started thinking, if the stock market went up next week and you did not have these positions, would you be upset? And I was like, not really. Nope, not at all. So luckily for me, I went back to my rule and I sold the positions that two positions. So I sold positions that, hey, I just bought in and didn't do the research on, and two positions that I felt I could be using my money elsewhere. So February 21st came and I sold a bit of Boeing. I sold my GameStop, which that one gave me a big loss. GameStop unfortunately gave me one. It was one of my biggest losers, but not by much, right? Even with that big loss of GameStop, my portfolio is still doing pretty good. I sold some Luckin Coffee. I sold Pinterest. I sold Turtle Beach, and later on in the week, I even sold Take Two Interactive. I actually even sold one of my good winners, Twitter, and that's because I felt that Twitter, even though I sold Twitter, doesn't mean most of these companies, right? Most of these companies that I sold, it's not that I think they were bad investments. That's not what I'm saying. Like, I'm not saying these companies are gonna go down. I'm saying that from where I understand these companies, I don't understand enough, or in the aspect of Twitter. In the aspect of Twitter, it was more of, hey, I believe that my money that I have in Twitter right now can actually be making more money for me, even though Twitter, I believe, will still continue to give me good returns. I believe that the returns I can get better returns elsewhere, and that's where I sold Twitter. So these are things you need to understand. Need to understand about yourself as an investor. So like I said, on February 21st, I took a loss on some of these positions, but I ended up increasing my cash positions to about back to 20%, where my gut feel, where my risk tolerance portfolio was good at. And if we take a look at, I was lucky, right? So I sold here February 21st. We can see this was the all-time highs. So I had taken probably a nice 2-3% loss from all-time highs. But look at that. I would have definitely been kicking myself if I did not sell that. And that to me told me, hey, you need to make sure to, even though you keep building up that cash position, make sure that you're only investing in the companies I truly understand. Because like the companies I truly understand, I did not care if those dropped. To me, it were okay. I would have been able to buy more on those. But the ones I didn't truly understand, I know I would have been like, I'm a freaking idiot. Why did I purchase these? So now let's take a look at what I did on the stock market after these drops. So every day so far, I think every day this week was about a 2 or 3% drop. So on the first one was on Monday. So Monday was the 24th, right? Monday the 24th, I bought some Disney and I bought some Huya. Two companies I'm completely bullish on. On Tuesday, and I also sold my Take Two Interactive, right? Another company. I am into the esports realm, but Take Two was a company I hadn't do full research on. I've done my research on Huya. I've done my research on Activisions, and those are the ones I'm really, especially Huya. I'm one I'm super invested into. Then the 25th happened, which was Tuesday. We saw another drop. What companies did I go on to buy? I ended up buying Disney, another Disney. I'm very bullish on Disney. I ended up buying Intel and I bought Yest. Again, all these companies are companies that I understood the company and I've done research on them. Then came Wednesday. Wednesday the 26th. I think Wednesday the 26th was a pretty flat day. It was, I think, was the flattest day of them day. So I only ended up buying more Disney. And this was the day Bob Iger, I think, dropped out of Disney and it still kept dropping. So I'm like, hey, I'm still fairly happy buying more Disney. So the 26th was Wednesday, where it was not much happening, right? It was a pretty flat day. I think it was the flattest day. 27th, we saw another 3% day, Thursday. And look, again, I went out and I went on a buying spree. I bought some Activision. I bought some Berkshire. I bought Disney. I bought Huya. I bought Intel. Like I said, I sold my Twitter, but not because I think Twitter is a bad holdings. It's just for me a holdings that I think I can do better returns somewhere else. I bought some Uber. I bought some more Space. I bought, luckily, this was one my wife told me about, and I did some research on. I bought this when the company was at $17. So to me, Space, even with that huge drop and huge incline, I'm still positive. So I bought some more Space, even though it dropped the 27th. All right, so that was good. Then the 28th happened, Friday, another 3% day. Friday was another 3% day. And what did I go? Hey, I went buying again. I bought Berkshire, I bought Boeing, I bought Cerence, all companies that I have done research on. I bought Disney, I bought Facebook, I bought Uber, and I bought Yest. So you can see, right? I after that big drop, after I controlled my risk tolerance, I felt happy, and I ended up buying companies. I ended up going on the shopping spree, and now to me, if the market continues to drop, I still have plenty of cash at hands, right? Even though I'm buying a lot of companies, I'm still maintaining a cash percentage to have enough risk tolerance. And right now, as the market drops, my risk tolerance is getting better. Now I'm like, okay, I'm okay buying more companies and dropping my cash down to 15%. I'm okay buying more companies and dropping my cash to 13%. Even if it continues to drop, I understand that I'm dollar cost averaging, and these are eventually in the long run are gonna give me better returns. So right now my cash position is dwindling, like it did when I bought these companies back then, but it's dwindling. It's going down on me buying companies I am 100% sure that I agree on. So that's what I'm doing. And if it continues to drop, I still have cash at hands, and I still have my deposits that I do every 2 weeks that are gonna help me continue to build this up. All right, so now we're gonna take a look at my closed position. So right, I sold my Twitter. Twitter gave me a nice about 10% gain. I sold Take-Two Interactive, right, company that I bought and sold real quick. I only lost $2 in it, and again, that made me happy. Pinterest. I bought during earnings because it dropped. I bought a small percentage, so all these were like I think 1% of my portfolio or 2% of my portfolio, and I lost only $7.95, right? So I was happy that I sold them because these prices on these companies are a lot lower, and I would have been kicking myself, right? This was where my mistake happened. Macy's, I ended up selling Macy's. It was a good profit for me, so that was happy. But I felt like the money here I can use elsewhere. Luckin Coffee, I sold some positions. I'm still in LK, but I sold some positions because I felt like I was too exposed in LK. So again, my risk tolerance level, I sold and I lost for 12%. Here again, esports company, I sold my position. I only lost 70 cents. GameStop, this was my biggest loser. I lost 144 on GameStop. But again, sometimes you just gotta, hey, I don't care if I took that loss. At the end of the day, I'll make that money back. Boeing. So if GameStop actually, if I did not have this loss of GameStop, if GameStop would have been flat, my portfolio would actually been on the green right now. And see, sometimes one dumb mistake can actually screw things up. Next, Boeing. I sold one share of Boeing, and I lost $14 on it. But I repurchased one. I just repurchased one again. So this short-term gain of $20, which is okay. So now this is my portfolio. So if you guys want to take a quick pause of it, this is how my portfolio is looking. And right, I'm around $90 down, 103. I guess it hasn't updated fully yet, so I'm still around that less than 0.5, about 0.5% loss compared to the almost 5% loss that I would have seen if I was in the SPY. So again, this is just my portfolio. If you guys want to take a look, feel free and pause. But then here I talk about February 17th versus February 29th. And these are two important dates. So February 17th was when the market was doing good, really good, right? And I was on travel. So this was the last time I updated my Excel sheet to understand how my portfolio was doing. And here, right, Berkshire cash, I had my cash position down to 7%. And that's when I was telling you, right, my risk tolerance was not liking it. And that's because I bought companies. These companies are less than 2%. Most of these are the companies that I bought without doing any true research on them. So my cash was sitting at 7%. But then I ended up selling those companies that I showed, right? I showed my close positionings. I showed my losses on them. And I was happy. I was happy with my results on that. I'm happy that I sold them. So here, right, I sold Twitter, I sold GameStop, I sold Take-Two Interactive, I sold Pinterest, I sold here, and I sold Macy's. These are now 0%. But look how my portfolio has shifted. My cash right now, after everything, after all those drops, I'm sitting with about 13% cash on my portfolio. So that to me is happy. I'm pretty happy on those results. So that means that market still continues to drop. I will still be able to buy more. I bought more Berkshire, so my Berkshire is now 10%. So Berkshire used to be 8% of my portfolio. Now it's 10% of my portfolio. I bought Disney. Disney used to be where? Disney used to be a small player. I think it was 4%. Now it's sitting at 7%. Huya was what? Huya was 5%. I increased it to 6.3%. Space, everything else is pretty much the same, minus those that I've closed off. So you can see where I went strong and started buying more shares off, and that was Berkshire, Disney, and Huya. And those are the ones that I think, if the market continues to drop, are the ones I'm going to be focused on a bit more compared to the other ones. What else do we have here? So right now, even though I still have 13% in cash, and what I ended up doing is, even though I do like individual companies, I also believe that sometimes I might be wrong. So to give me some form of leeway, I wanted at least 20% of my account to be in some form of ETFs. Berkshire, in my mind, I consider a form of ETFs because they're diversified into plenty of companies, and the companies in there I like. So I have about 21% in cash in ETFs. I have 13% in cash. And you can see here, I give you guys the ETFs and the types of companies that I'm in. So now for my future plans. So my future plans, every 2 to 3% days that are down, I'll buy. If it's a flat day, I won't buy unless the individual company is down. I'll stop buying companies just to buy. I'm gonna do my full research, because I was doing that, and that was kicking my risk tolerance, and it's what I wasn't liking. And follow my gut from time to time, but understand my gains and losses that can occur. Right? My gut was telling me for a bit, hey, start buying these companies to get some cash working. But I was also understanding that I was buying these companies that I wasn't doing full research on them. So I also used some form of risk analysis to be like, okay, I'm gonna buy these companies, but I'm gonna buy a small percentage of them. And you can saw I only bought like 1%, 1 or 2% of my portfolio at most. So even though I knew I was breaking my rule, I was trying to offset it by buying smaller positions. So that's it. That's all I have. I hope you guys enjoyed this episode. Post on the comments and let me know what you guys think. Have a good night and see you next time.